Actually, are we or are we not? Let's ask Arvind Sanger this question. He's managing partner at Geosphere Capital with us on the show today. Arvind, thanks for waiting by and thanks for joining in today. Really good to talking to you this morning and this evening, your time. How do you look at the setup now? Because it seems that the two temporary positive points have turned to be pain points, right? Yields, crude prices above 80. India is kind of being singled out for punishment, at least in trade yesterday. How do you look at the setup from a global perspective and what happens to India?
Well, look, India benefited from a lot of confluence of factors coming together. One was, Tina, there is no alternative, right? India was the only game in town in terms of major emerging markets. And second was, I guess a benign set of circumstances on a lot of fronts, like you talked about crude oil, interest rates were heading down, Fed was cutting rates, everything was going well. So now you've had a few things upset the apple cart. Obviously, you had some negative surprise on US growth, which suggests negative in the sense that it was, stronger than expected employment numbers, which means that the easy glide path to Fed cutting another, 75 to 100 basis points in the next two meetings is no longer that straightforward. So the cuts might be less. And don't forget China, right? China has been a dog in terms of a market for the last 2 years plus. And now we've seen some breath of life coming back into the Chinese market because of actions by, the Chinese central bank and the Chinese Politburo, and all of these incentives are causing investors to realize that, China's valuations are less than 1/3 of Indian valuations in terms of valuations in many parts of the market. And therefore, there has been some, playing the laggard trade. So I think these factors have come together. And then, oil going up to 80 is not a big risk only for India. It's a risk for China. It's a risk for other oil importers. So I wouldn't put that as the singular reason. But I think, there's a little bit of a risk off going off in global markets because of uncertainty about what might come out of the Middle East. So that's a, third added element, if I may add.
So, hi Arvind, Tamanna here, and good morning to you. In the midst of all of this, how is India positioned and how is India looking? Because we went over an interesting CLSA note yesterday, which talked about going overweight on China, and the cost of those funds are coming from India. Has it become, in a sense, for a lot of global funds in India-China binary, and right now, China is looking more attractive?
Well, I look, you can take a short-term view and you can take a long-term view. In my opinion, China is a trade, India is an investment. So let's separate that in terms of the long-term perspective. But having said that, clearly India's valuations have been at nosebleed for a while, and no tree ever grows to the sky. And India is no exception. When people talk about this time is different, that's nonsense. That's been said all over the years in several markets at the top of bull markets. So, India is not something that's going to walk on water. And the valuations need to reflect reality that Indian growth is good. But, 7 to 8% GDP growth is not earth-shattering. So China with its valuation, yes, we'll see some funds flow and probably deservedly so in the short term. But longer term, investors, once we get stabilization and some valuation retrenchment to somewhat more reasonable levels in India, then people realize that from a long-term standpoint, the India growth story has solid underpinnings, but we have to watch. Let's be clear. We have a quarterly earnings coming up here for the September quarter, India's fiscal second quarter. Let's see how the earnings do. There are, mixed signs. So I'd like to see the short-term trajectory confirm what we think is happening in the medium and long term, which is a solid, earnings growth story, which we're, reasonably confident about. But short-term valuations have moved up so much that even with this pullback, it's not like India has become a screaming buy right now.
That's the question, really. I heard you say that to more reasonable levels. So is that more reasonable level 3-4% away from here in the large caps? And in that period, if the markets were to retrace to those levels, will mid caps and small caps suffer more?
They will, and they probably should, because their valuations had gotten extremely excessive. And clearly, SEBI is getting into the act in terms of some of the actions they've taken to try to reduce the speculative fervor in the mid and small caps. So yes, we are interested across the cap spectrum, and we'd be more interested in mid caps who are maybe 10-15% cheaper. I think that would cause us to be a little more interested in things from a valuation standpoint. So no, we are not at valuations which make India a rip-roaring buy, but we're moving in the right direction.
Arvind, you made that interesting point about a trade versus an investment. When does that paradigm shift again? I mean, you're seeing some statements coming out of China right now, and that's looking very, very rocky for the Chinese market, the Hang Seng reacting quite violently even as we speak. Does that pivot take place sooner than expected? Does the China sort of let's get back to China mood change sooner than expected?
That's so hard to call because it depends on what China's next policy measures are and how far they're willing to go. I remain skeptical that China can fundamentally alter the trajectory of their problems, whether they are overinvestment in real estate, which is now going away, whether they're demographic challenges, or whether they're the fact that President Xi doesn't fundamentally believe in the letting the private sector take leadership and move the economy forward. So all of those factors, none of those have gone away. The question is how much are they willing to do in the short term to turn their economic trajectory around? And I don't know the answer as to how soon it'll become apparent that maybe China's efforts are more half-hearted, or will they go further than what I skeptically expect them to do? So that's in Chinese policymakers' hands. But my sense is, even if they continue to do more, in the next 2 to 3 months, it'll become apparent that it's not going to change the fundamental trajectory. Whether that'll become apparent in the next 1 or 2 weeks, I don't know. Look, nothing ever goes in a straight line. And China's not going to go in a straight line up. But I suspect we still have maybe a few weeks to run of the China, kind of hope trade.
Okay, so the China hope trade continues for some time, but bigger picture here, Arvind, let me come back to the US markets just for a bit. The celebrations on Friday evaporated fairly quickly. Bond yields now hardening. Are you seeing that continuing? And how worried are you about the flare-up that we're seeing in the Middle East?
Well, the flare-up in the Middle East is clearly, in uncharted territory. Clearly, Israel, and that comes back to the U.S. market. The U.S. market doesn't mind if growth is doing better than expected, even if that means Fed doesn't cut as much as expected. Because you have to be careful what you wish for. If the economy is slowing down a lot, and Fed is trying to help it, that would not be great that we're going into a recession. If economy is seeing inflation and not growth, that would be a problem. But what we are seeing is growth and not that much inflation. So maybe we're in a sweet Goldilocks spot, and at least that was what the market was hoping for. But the wild card that has upset everything is the whole Israel-Middle East situation. And we don't know what Israel's retaliation will look like against Iran. And we don't know what Iran's retaliation to Israel's retaliation will look like. So there's all kinds of, the fear of the unknown is more than actually, when we know what's happened. So right now, I think the market, having had quite a decent run, is taking a little bit of chips off the table. Let's not get carried away that this is, any kind of an end of a cycle. It's just taking a few chips off the table, sitting on the sidelines a little bit, waiting to see where this thing goes before committing more capital. I think that's healthy, and I think that's understandable. I don't think it's in any ways anything cataclysmic.
Okay, Arvind, just stay on because there are some flashes. Would want your view there because China NDRC chairman has said, given out some news flow, right? China will keep using ultra-long sovereign bonds, allocated almost 6 trillion yuan of government investment in 2024, will expand loan support policies in medium term as well. But if a lot was anticipated, it seems that there is a bit of an underwhelming response by NDRC at the briefing that was on just a few minutes ago. Arvind, would the Chinese rally B, would have been a lot dependent on what the pressure would have done today, and if it is underwhelming, while the Chinese stocks have paired some gains, is the trajectory still on the upside for China?
Well, my sense is with all these statements by PBOC, by the Politburo, now with the NDRC, I don't think we've come to the end of the statements, right? So if it's seen as not enough, will they follow up with something else, right? So the question really becomes, how far are they willing to go? And are they in this mode of whatever it takes, to quote a famous Draghi phrase from the previous financial crisis. So in that sense, it may cause a pullback. Again, it's not going to be a straight line. But the question is, will they follow this? If this is seen as not sufficient, will they do something else after this? So my sense is we're not at this end of the Chinese bazooka. Whether that bazooka is enough or not, time will tell. And I remain skeptical that it can fundamentally alter the trajectory. But can it cause the Chinese economy to come out of this nosedive that it's been on? It certainly can, and I think they will try to do what they can. So I don't think today's statement is the be-all and end-all of the Chinese effort.
Absolutely. There's a quick reaction, though, coming in. Thank you so much, Arvind Sanger, for speaking with us. Always a pleasure to have you on, and very sharp reaction. And just let's quickly pull up the Chinese markets as well. This morning is somehow becoming a lot about China. We'll come to India also in a bit, but the Hang Seng down nearly 7%. Shanghai is doing okay, 4.5% up. Nikkei also in pain. The implied open for India